Hi, everyone. Welcome to video number 1 for chapter 5. In this video, we are going to chat about billing schemes. And then I will also have some videos for you about some other schemes that we read about here in chapter 5. So let's first just get started with our billing schemes. Billing schemes basically occur when we have falsified documents that are going to cause our employer to lose money. So when we submit false invoices or collude with other people to get around some controls we might have in place, pay our own credit card bills. Some of these things are what we see in billing schemes, and they're going to fall into 3 main categories. So the first is shell companies. So when we create a fake company for the sole purpose of deceiving our employer. Non-accomplice vendor schemes, when we have legitimate vendors and we circumvent certain procedures in order to use those to gain access to some of those funds. And then personal purchase funds, that's when we're using our own credit card or paying our own personal expenses with the company card. That's an example of that. So let's chat about the shell companies first. So again, a shell company is just a fake company that the employee is going to create for the sole purpose of committing fraud and submitting fake invoices to the company to get paid. So to form this shell company, it's going to start with the fraudster. In order to open a bank account, they're going to have some sort of certificate of incorporation, which is pretty easy to obtain from the state or local government. So they're going to start by doing all the paperwork to open up this entity in name only with the state to incorporate. And then they'll use that information to open up the bank account. From here, the bank account can be used to cash checks that are coming in from these fake vendors. So sometimes, if they are creating these shell companies with their own name or their own address attached, it would be very easy when the fraud is found out to see, okay, this shell company is owned by this individual is our employee. So sometimes they may open them up with maybe their spouse's maiden name or their mother's maiden name or someone else's name completely, someone else's address, just so that they don't ultimately get caught. After they have the shell company formed, then they will submit false invoices to the company. So a false invoice is simply that. So it's just some sort of invoice that they have that might look like a professional quality invoice. And oftentimes these individuals will have the ability to approve these invoices. So they have they're lacking some sort of internal control. So they're able to approve these false invoices in order to eventually pay themselves. So then when we move on, when does this happen? So a rubber stamp supervisor is an inattentive or overly trusting supervisor. So the employee puts in this false invoice, and then the supervisor just rubber stamps and doesn't really look into anything, doesn't suspect that anything would be wrong. So all of the invoices that come in just automatically get paid. When we do have some sort of approval process where the supervisor isn't just rubber stamping, then we have to think about who has the authority for this purchase, and is this voucher going to get processed through the typical channels? And do we have the backup in order to move this payment forward and get paid for it? So this brings us to collusion. So collusion is when people will work together to circumvent those controls. So that we would like to have properly designed segregation of duties. So purchasing goods or services, authorizing the purchases, receiving the goods and services, making the payment, all of those functions should be separated in order to minimize some of these issues. But when people that have these different functions work together to circumvent the controls that we have put in place, that's when fraud could happen in some of these schemes. Oftentimes these false schemes, these companies, the invoice will be for services rather than goods, because if we are getting some sort of good or inventory in, we should have more documentation. Whereas if we're paying someone for consulting services, we don't really have any documentation for that. So a lot of times we will see that the fake invoice is for a service rather than for goods. And then finally, pass-through schemes are a little bit different than what we have talked about so far. So in what we've talked about so far, the company is billed for fake goods. So we're being billed for things that we never actually purchased. In a pass-through scheme, this is a little bit different because we actually are going to pay for goods that we have received. But the problem is that the shell company is going to buy them first. So let's say we're buying lumber. So the shell company will buy the lumber from the vendor that we would typically buy that lumber from, and then resell it to the organization at a markup. So they are inadvertently adding additional costs to whatever is being purchased because they are making it flow through their shell company rather than just purchasing it directly from the vendor. So how can we prevent or detect shell companies? So as I said, having that proper segregation of duties as we go through all of these is going to be imperative. So we need to make sure we have the proper controls in place and segregation of duties. We also want to have a approved vendor list. So if we have a shell company that's created, they would not be on that approved vendor list. So anyone that we are trying to pay that is not on our approved vendor list should be independently verified by someone other than someone whose job it is to typically make those purchase authorizations. So that is the best way, is to have that approved vendor list. And again, make sure that all the vendors are legitimate. And if we are paying someone that's not on that list, have that independent verification. So what if we do have a shell company? How can we identify it? Well, the invoice is going to lack detail. Again, it might just say consulting, but it doesn't necessarily tell you exactly what it is that you are paying for. The address might either be a residential address or a PO box. So that is another red flag. The invoice numbers might be consecutive. So a legitimate business might bill one customer with invoice 100, and then another customer with 101, and then another customer with 102. So your invoices for a specific customer wouldn't necessarily be in order. But if we have a shell company whose sole purpose is to fraudulently bill one employer, we're going to see invoice 100, 101, 102, 103, maybe sent once a month throughout the year. So we'll see those orders consecutively in order. Also, we'll see the same amount billed over and over and over again. And oftentimes that amount is going to be just slightly below what the person who is running this scheme has authorized. So maybe they're authorized to approve purchases up to $20,000, and we consecutively see like 19,500 right under their threshold. That's another key indicator or way that we can identify some of these shell companies. So how can we test for these? So sorting payments by vendor, by amount, and invoice number is one way that we can search for red flags, but there are others as well. We can be alert of large budget overruns. So if we are paying a company and that really isn't there, and we see that certain accounts are going over budget, we can investigate why we're going over budget, and we'll see those items. So a horizontal analysis is basically comparing financial statements 1 year to the next. So if we see large growth in a particular expense, that could again be an indicator that something is in that expense that shouldn't be, and will give us a place to start. Same with analyzing expense trends. Reviewing purchase levels. We can look at how much individuals are purchasing and whether that seems, if the amount that they're purchasing has gone up relative to what their job is, and see if that seems legitimate. Matching the perpetual to the physical inventory. So this again will help if we are paying for goods that never actually arrived, and seeing if we have increased shrinkage, looking at our average unit price and the types of goods that are being purchased. Using big data, we can compare our vendor file of where we've sent those vendor payments to our employee addresses and see if any of those match up. And then finally, thinking about turnaround time on invoices. That could be another test that we could do to find those falsified items. So how are we going to verify if a vendor payment that looks fishy is a shell company? So we're going to start by looking up that vendor. So maybe if it's a legitimate company, we would expect them to have a website. If we can't find their website, can't find them in the phone book, we might contact other people to see if they know them, go to the address where business is supposedly conducted, and see if we can see if this is a legitimate business source. And then after we've identified that we have a shell company, how can we identify who created this? So as I said, when they set these up, they often won't use their own name or address. But we would want to search that company registration to see if it happened. Then we could go and pull where these checks are converted. So we sent them payroll checks. Where exactly are they depositing these amounts? And then we could look at the payroll checks and see if any employees were also getting their checks deposited at that same bank. We can have surveillance at the mail drop. So once we've identified that PO box, we send them another check, and we have some surveillance to see who is there. And then we could also just talk with the people at that PO box, at that post office box, to see if they can identify who the person is. The next type of billing scheme is the non-accomplice vendor. So non-accomplice means they're not involved, and a vendor is someone who is our supplier. So basically what this means is the employee is using the information from this vendor, this legitimate vendor, in order to get paid. So one way to do that is to purposefully pay the invoice twice. So we get an invoice for, $1,000, we pay it once, and then we pay it a second time, knowing that they're going to reimburse us for that second payment. Similarly, we could pay the wrong vendor and the correct vendor, overpay, maybe not double it, but pay too much, and then request that amount to be sent back. When that amount gets sent back, we take that check and never deposited, and the mistake is never actually caught. We're just getting that money. So that is one way that we can have the non-accomplice vendor. So how can we prevent or detect this? Again, this is largely dependent on that purchasing function. So making sure that the invoices are being paid only once is one thing. So marking things as paid electronically, making sure things are only paid once. When they enter in an invoice number, making sure that we have controls so invoice numbers can't be duplicated or entered twice. Separation of duties. When we get checks in, we want to make sure we have some sort of remittance advice that's going to tell us exactly how much it is, so the person can't steal those checks out of the mail. And then finally, instruct the banks not to cash checks payable to the organization. So we should be strictly endorsing all of our checks for deposit only. We shouldn't be cashing any of those checks that are coming in. And then the last type of fraud that I want to talk about today is personal purchases with company funds. So instead of undertaking a billing scheme to generate fraud cash, what these people will do is just make personal purchases with the company's money. So this could be something that the person is using in their own business. It could be something for their friends, whatever it might be. We're just going to use companies' funds for our personal use. So it's going to be similar to our theft scheme. We're not taking inventory, but we're purchasing inventory and then taking it. So we're either purchasing too much or purchasing things that we don't need, and then we're taking that amount or that extra purchase for ourselves. So purchasing through false invoices. So what this means is we are falsifying those invoices to purchase these items. As we saw in other schemes today, oftentimes the fraudster has the ability to authorize these invoices. So they're going to submit this false invoice to get the company to purchase stuff, and then they have the authorization to approve that. So again, having those proper segregation of duties, I sound like a broken record, but that is critical to a lot of these fraud schemes. So if they aren't able to authorize their own purchases, then they might have to rely on other methods to get the company to pay their personal bills. So that's where the falsifying documents to obtain authorization comes in. So if they can't approve their own purchases, they're going to have some false documentation in order to get the company to pay them. One way they can do this is by altering the existing purchase order. So they're going to either add extra materials that already exist, or increase the amount that's being requisitioned on an existing purchase order so that we're ordering extra items that we don't actually need. We could also falsify a purchase request or purchase requisition that indicates we need some additional things when we don't really need them, and then alter the shipping address and the receiving reports so that they go to the employee rather than going where they're supposed to, or they were never needed, so to the company. And then the last thing today is personal purchases on credit cards. So this is something that happens a lot. So when people have a purchase card, they can make personal charges on that company card, or run accounts from the vendor. And if no one is keeping track of what is spent on those cards, we can run into a problem. So just like we saw with those invoicing schemes, we need to have good segregation of duties so that we can have proper approval and monitoring over these cards. What else? Returning merchandise for cash. So we buy goods on the card and then return that and get the cash instead. Excuse me. And then how can we prevent or detect these purchases? Again, having that review of those credit card statements so that we have people who are reconciling and comparing the purchases with legitimate backup is going to be something that we will need. So I have a couple more videos today for us on the other schemes. So be sure to tune in for the remaining schemes that we're going to talk about here in Chapter 5. Have a great day.